QBI deduction refers to qualified business income, and simplistically, for businesses that are that pass through to an individual tax return, like a partnership or an S corporation or a sole proprietorship, it's a deduction equal to 20% of the net income of the business, which seems simple, but there are limits on it based on the amount of wages that you pay during the year, or potentially based on the amount of depreciable property that you have in service. There are certain types of service businesses that don't qualify, attorneys, accountants, money managers, that sort of thing. If their income is above a certain level, it doesn't qualify. They may be able to get it if their income is below a certain level. So something that seems simple, like multiply your net income by 20%, becomes a whole lot more complicated when you throw these other limitations on.
And obviously there's a lot of planning that needs to take place, or may need to take place, with regards to QBI, especially if you're above that $315,000 limitation. You may want to be thinking about choice of entity, maybe setting up another company for management purposes. And so there are planning opportunities that can occur around the QBI deduction.
The interesting thing about the QBI deduction is that, used to, if we were kind of almost any type of entity, whether we were an S corporation or a partnership or a sole proprietor, we really ended up with the same tax. And now that can be very different. You could have the same business making the same amount of income, but structured differently in terms of different type of entity. Could have a different answer for the QBI, which is really one of the first times that we've had that that happen. So therefore, again, we just need to be able to have a conversation sooner rather than later, so that maybe we can help adjust that to get the maximum benefit from this brand new law that is, I don't think we've ever had any kind of law like this where you just don't tax 20% of your income. So it's going to be a real game changer. It's going to be a real more difficult process than most people think it is for us.
Yeah, and if you have, for example, an S corporation where you have a sole shareholder, he has wages that he pays himself, and he has the business income that flows through. The wages are taxed at a rate that's 20% higher than the business income that passes through. But then there's limitations on it based on the wages, and so you need to be sure that you have enough wages being paid out to get the full benefit of the 20% deduction, even though the wages are taxed at a higher rate. So it can get very complicated to make sure that you're taking full advantage of the benefit.
And I think the one item that's interesting when you think about how does the 20% impact a taxpayer, when you're looking at somebody who's in the 37% tax bracket, the 37% on those wages with the 20% deduction, quantified as about a tax bracket of 29.6%.
It's a big change,